Hey there, everyone. Dave Keller here with Market Misbehavior. Today we're going to talk about Dow Theory. Now, a lot of times when I refer to Dow Theory in my work, like on my market recap show called Chart This with Dave Keller, we use what I call newer Dow Theory, which is taking Charles Dow's original foundational work from the early 20th century and kind of modernizing it a bit using the S&P 500 and the NASDAQ. Today we're going to talk about old school classic Dow theory, what Charles Dow's original work was, why the fact that transports aren't doing particularly well right about now may be a warning sign for the markets going into the fourth quarter. Before we get to some Dow theory charts, some talk about some of the transport stocks in particular, some of the components of the transportation index and what their charts are telling us, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. So I like using this particular chart style to compare two different things. I call this my comparative chart. I've got the Dow Industrials in the top half, the Dow Transports in the bottom half. We're using the indexes to track these two baskets of stocks. Now, why are we making this comparison? This goes back to Charles Dow, early 20th century. We'll include a link if you want to learn more about Dow Theory. Great book by Jack Shanup called, I think it's called Dow Theory for the 21st Century. Awesome read. You should check it out. But what Charles Dow basically described in a series of essays back in the day was a lot of the foundational concepts that we still use as technical analysts here in 2025. Looking at trends and analyzing charts of indexes over time. That was Charles Dow's contribution, or one of them. Just the way we define trends, looking at the highs and lows and how they evolve over time, came from Dow's work as well. And then finally, what we now call Dow Theory, which is how we compare different areas of the market or different parts of the economy to see if they're in agreement. What Charles talked about back in the day, there were 15 stocks in the Dow Industrial Average and 15 stocks in the Dow Railroads Index. And the idea was the producers of goods, the industrials, and the distributors of goods, the transports, right? So kind of the American economy in the day, two main buckets, the companies producing stuff and the companies taking that stuff and getting it out to where they needed to go. And those were railroads back at that point. So if both of the indexes are going up, that's bullish because the producers and the distributors are all thriving. If the industrials and transports or railroads are both going down, that's bearish, a confirmed bearish market because they're both struggling. A warning sign would be what's called a non-confirmation. If one of them breaks out and the other one does not, instead of being a confirmed bullish environment, it would be a non-confirmation. That is the situation we find ourselves in here using classic Dow theory. Again, in the top half, we have the Dow Jones Industrial Index, now comprised of 30 stocks, not all kind of classic industrial companies like they were, which was what it was like back in Charles Dow's kind of day. Think like 3M, big industrial conglomerate kind of companies. That's more what those names were back in the day. And then you have Dow Transports, and the Transportation Index is now comprised of 30 companies. It's airlines, trucking companies, railroads, shipping companies like FedEx and UPS are all in the Transportation Index. But the methodology, we can use a similar methodology to what Charles Dow described, right? When both of these are making new highs, like you see in November of 2024, that's bullish, right? When they're both breaking to new highs, because that tells you the producers of goods, the industrials, and the distributors of goods, the transportation stocks, they're both going up, conditions are good. When they're both breaking down, like we saw here, after the February market peak, neither of them actually made a new high in February. The S&P 500 and the NASDAQ did, but the Dow Industrials and Dow Transports actually made lower highs in January and February. That's worth noting here. However, both of them broke to new swing lows at the end of February, beginning of March, when they both sort of made a new swing low and went to the downside. So what's happening more recently? Let's take a look here, and you can see that we have what's called a bearish non-confirmation. That's when one of these I can't zoom in for some reason, not sure why, sorry. That's when one of them is making a new high and the other is not. So here we have the Dow Jones Industrial Average making a new all-time high in September of 2025. Here's the Dow Jones Transportation Index, nowhere near its previous all-time high, which was from November of 2024. As a matter of fact, we've been pounding out a series of lower highs from that moment on. So look at this, just the last 6 weeks, right? Industrials breaking out, transports not breaking out. So that's called a bearish non-confirmation. That suggests a lack of optimism for economic growth because the transportation stocks are showing that, there's not as much demand, there's an oversupply, whatever it is. The getting the goods out to the consumers not going as well as you might think. So let's dig a little bit more into the Dow Transportation Index. And to be clear, this Dow theory would really be negative if both of these broke down, which means transportations would need to break below, we'll call it 15,150. The Dow Jones Industrial Average would need to break below 43,500. A new swing low on both of those charts would be a bearish confirmed Dow theory signal. For now, it's just a non-confirmation. It's a red flag. It's a warning sign that we might be at or near a market peak. So to understand this a little more, we have to dig into the Dow Jones Transportation Index. And I'm actually using the ETF here. Good news about the world of ETFs is most indexes, at least the popular ones, almost all have ETFs that track usually very closely their holdings. So we can look at and ETFs are pretty transparent, right? You can bring up on different websites the holdings of those ETFs. You can understand what's actually driving their performance to the upside, or in the case of transports, kind of the mixed results and some of the stocks pushing to the downside. Here's the Dow Jones the Dow Jones Transportation ETF, and it's actually the iShares Transportation Average. It doesn't explicitly say that it's tracking the Dow Jones Transportation Index, and there could certainly be some differences in weighting, but this is an index that tracks pretty closely the members of that Dow Jones Transportation Average, and that's why we're using it here. Of course, we can see that while the S&P and the NASDAQ have made new all-time highs, of course, the the iShares Transportation ETF has not done so. Now, on the plus side, it did recently bounce off of its 200-day moving average. It did more recently bounce off of its 50-day moving average, close to breaking above pretty clear resistance around that 73 to 74 level. So I think, set an alert for the IYT to break above 73 or 74 would be a great way to track this chart and see if it does kind of get the upside follow through. But for now, it's actually been not making a new high. So why is that happening? What's been driving this performance? I'm using Koyfin as one of the ways to drill into the holdings of this ETF. I use this platform often to bring up an ETF like IYT. We can look at the sector breakdowns. We can see, of course, that this is almost entirely made up of the industrial sector. Looking down at the industries, you can see what's called ground transportation, which would be railroads and trucking companies, make up about 64% of the ETF. Passenger airlines like United, Delta, Alaska, others, JetBlue, 19%. Air freight and logistics, that'd be like FedEx and UPS, and then smaller groups make up the rest of it. But you can see what a top-heavy index this is in particular, and this is where the weightings of the transportation ETF could differ from the weightings in the Dow Transportation Average, because that's more price weighted, which means you're going to have the larger the price, the bigger it's going to be weighted in the ETF. That's what most of the Dow indexes do. In the case of the IYT, you can see Uber is almost a quarter of the ETF. 23% is just that one stock. Union Pacific is 15%. Then you have United and Delta, which together make up around 11%, and then we kind of go down below there. So let's look at some of these bigger weightings and how they've done. So what's interesting is, even though the IYT is well below its previous all-time highs, and even though the transportation index has been struggling, Uber's not a bad chart, right? This makes up about a quarter of the IYT, and if you're wondering why IYT maybe looks a little bit better than you'd expect, it's because Uber looks so good, right? And Lyft, which is also in the ETF and certainly in the Dow Transportation Index, also making new 52-week highs again this week, up about 3% just on Friday alone after the gap higher that we saw on Wednesday. So Uber and Lyft, you don't think of these as transportation stocks, as in the distributors of goods. And this is what I was talking about, the modern era of the Dow Industrials and Dow Transportation, right? The industrial average includes big banks like Goldman Sachs. The transportation average includes Uber, which is, arguably not really doing much in terms of distributing goods, but is distributing people around major metropolitan areas. And those are two things holding up those indexes just fine. You also have Delta, which is arguably, I'm out of the airlines. Some of the airlines do not look this constructive, but look at how Delta has actually broken above the 200-day moving average. Look at a number of pullbacks to an ascending 50-day moving average that we've experienced since breaking above it back in May. That's been a really kind of classic uptrend phase of higher highs and higher lows, most recently pulling back to support. Now, notice how in this last test of the 50-day moving average, the RSI has remained above 40. It's kind of a classic pullback to the 50-day type of approach. Pretty constructive. So those are three charts that look quite good. Those are three stocks that are in that transportation ETF IYT. Here's a problem, right? None of those three stocks are actually in the business generally of getting goods out to people. Not like Delta will have cargo operations that are in line with their passenger efforts, but obviously being a passenger airline is their primary business. So those three charts, while they look quite good, are not really getting to the essence of what Charles Dow was talking about. He was talking about more about this kind of company, UPS, more like this one, the Old Dominion Freight Line, both of which are at or near new all-time lows or new 52-week lows here in September of 2025. This is the issue with transportation, right? This is why the fact that transportation stocks, at least the ones which are really responsible for getting goods from producers out to consumers, are struggling, right? Two main ways we think of that would be in shipping companies or freight companies like UPS, and then trucking companies like ODFL. Let's look at both of these charts and talk about why these charts are so negative. So as a trend follower, my initial assessment of a chart is just to say, all right, is this chart going up, down, or sideways, right? A chart at any moment can be in one of three directions: trending higher, trending lower, trending sideways. In the chart, in the case of UPS, we're clearly trending down. Now, how can we better define that using the language of technical analysis? First off, we can look at the price action. Is the chart making higher highs and higher lows, like we saw in the case of Uber or with Delta Airlines? In the case of UPS, no, we're making lower lows and lower highs. So the trend is down as defined by Charles Dow's original methodology of just looking at the highs and the low prices. We can look at the moving averages, particularly the shape of the moving averages. We can see that the price is below the 21-day EMA, the 21 days below the 50-day moving average, the 50 days below the 200-day moving average, and all those moving averages are sloping downwards. So when you have all of those moving averages sloping downwards and the price below them all, that is a chart in a confirmed downtrend. Is there anything to be optimistic about with the chart of UPS? If you're a contrarian, right, if you like buying value-oriented names, then yeah, you can see that the stock is trading at a fairly low valuation, a PE around 12.5, which means you're not paying too much for the expected future earnings of the company. We can see a potential double bottom pattern because we made a low at the end of July right around $82, $83. You can see we basically retested that earlier in September, and for now we're holding that level of support. So, looking at that as an opportunity to buy in on the potential low and play upside from there. There's an argument to be made. Also, I would say the fact that the RSI is sloping high. That's how you know this is real. AI does not include sneezes in the presentation. We'll get back to the chart. You can see End of July, mid-September, lower lows in price, higher lows in momentum. We're oversold at the end of July. We're not oversold second week of September. So there are some signs that potentially we're bottoming out. But from a trend following perspective, I'm not seeing anything but a downtrend here in the chart of UPS. What about ODFL? Kind of the same argument that we just had with UPS. Is it in an uptrend or a downtrend? I would argue very much a downtrend, as evidenced by the fact that we're seeing lower lows and lower highs. What about the shape of the moving averages? Also bearish. Price below the 21-day EMA, which is sloping down. That's below a downward sloping 50-day and a downward sloping 200-day. The moving averages are in a bearish configuration, telling us we're in a downtrend. Is there anything to be excited about? I mean, not much by my trend following awareness, but from a contrarian point of view, we are retesting the lows. Now, arguably, we made a new 52-week low just on Friday, September 19th, so it's not really setting up particularly well. But keep an eye on RSI. I think it's a little too early to say that this is also a bullish divergence like we, I think, could say with UPS. Here we have an active downtrend. The stock is making a new low today, which means if we continue lower next week, the RSI could end up going much lower before all is said and done. But looking to see if we find some sort of tradable low in ODFL with the RSI not getting below 30, that would actually be a bullish momentum divergence and suggest further upside. As a trend follower, though, with charts like this, I tend to be patient and wait for a break above the 50-day moving average just as an initial sign of enough accumulation that it's worthy of my attention. So, going back to Dow Theory, what is Dow Theory telling us now? It's suggesting weakness. It's suggesting weakness under the hood, even though the S&P, the NASDAQ, and even the Dow Jones Industrial Average all made new all-time highs in September of 2025. Transportation stocks are not doing so. We broke down the chart of IYT, particularly the holdings of that transportation ETF, to see which stocks were really driving the performance to the upside or downside. The good news for transportation ETFs and indexes is that stocks like Uber, Lyft, and even charts like Delta Airlines are fairly constructive here in making higher highs and higher lows in primary uptrends. But the problem is the traditional shipping companies, the trucking companies, the companies that are really modern, evolutions of those railroad stocks that Charles Dow was analyzing in the early 20th century, those charts, many of them do not look particularly strong. That weakness in the distributors of goods should give investors pause here in September of 2025. What do you think about this breakdown of Dow Theory? Have you used the transportation stocks or ETFs in meaningful ways? And where are you seeing opportunities in these types of names? Make sure you drop a comment below. Tell me the tickers and techniques that you were using to identify opportunities here in September of 2025. For Market Misbehavior, I'm Dave Keller. Don't miss my daily market recap show called Chart This with Dave Keller. It's live streamed here on YouTube and on other social media platforms, and you can see all of our previous episodes right here. But in the meantime, have a great one. And remember, it's always a good time to own good charts.